Hey everyone, in this video I've got one growth stock that's down 54% off its high that you might regret not buying on this dip. So this growth stock is Atlassian Corporation, and I'm going to explain why I think the stock is a buy right now. Starting with phenomenal revenue growth, Atlassian has capitalized on the hybrid cloud trend. The company's growing to 3.535 billion in trailing 12-month revenue. That's up from less than 500 million in revenue in 2006 before 2016. Management expects this growth of above 30% to continue at least for the next quarter, so it is finding revenue growth despite difficult macroeconomic trends. Now, one concern for this company is the cyclical up and down nature of its operating profit margin. It doesn't show clear, consistent signs of improving its operating profit margin. You see it declining near 12% before rising above 6% and then declining back down to negative 9.77%. Now, as is common with companies like Atlassian, with tech companies, they use significant amounts of stock-based compensation. So why don't we look at cash flow from operations to get a better picture of how good this company is at turning sales into cash. And looking at this metric, we get a better picture of Atlassian. Well, we get a more optimistic picture of Atlassian when you see this consistently rising cash flow from operations. The company generated 868 million in cash flow from operations in the trailing 12 months, and considering it generated 3.5 billion in revenue, that's a good percentage of revenue that's turning into cash flow, especially for a company that's still growing at 30%. So this is an excellent metric for Atlassian, and I'd like to see this turn into also positive operating profit margin in the near term as well. And finally, I wanted to look at valuation, and judging by this metric, the stock is not cheap. Atlassian is trading at a price to free cash flow of 63.58, which is roughly the average price this stock has traded at going back the last 5-6 years or so. The stock was trading at significantly higher valuations during the peak growth times in the middle of the pandemic. And now it has come back down to valuations it was trading for before the outbreak. So you're getting it at a fair price, not a cheap price and not an expensive price. And you might say, what? A price to free cash flow of 63 is fair? Isn't that expensive? Well, if you consider the growth the company is achieving, then paying a price to free cash flow of 63 is fair because of the growth. If it was a flat company where it didn't have any growth or its growth was much slower, then I would certainly say a price to free cash flow of 63 is too much to pay. But the company is demonstrating phenomenal revenue growth, and at the same time that revenue growth is turning into excellent growth in cash flow. And so with these kinds of metrics in terms of revenue and cash flow growth, I don't mind paying a price to free cash flow of 63. So for all of these reasons, I think you might regret not buying Atlassian stock at these reduced valuations.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.